what makes Forex the best market in the world to trade? Well, despite the hype that we see numerously across the internet, the key things that make Forex such an ideal market in which to learn to trade are that it's open 24 hours a day. It means you can work it a long time alongside a job. You don't have to be sat at your screen all the time. The market's open 24 hours a day. There's a low cost of entry into the marketplace. There's also a high reward. You can actually generate good returns on your investment. And it's the largest market in the world. $4 trillion reportedly is traded on the Forex market every day. So, Forex is a 24-hour market. Why is that? Because it's the global transaction of money. There are three key sessions that happen during every 24-hour period. The Asian session, the European session and the American session. The biggest by far is the European session, which accounts for around about 75% of the Forex market and all the trades that happen in any 24-hour period. For novices, Forex is ideal because it allows you to experience live trading without risking lots of your own money. Live charting software is provided for free by the brokers. In comparison, stock charts are typically $200 a month. Also, you can trade demo accounts, which basically enables you to access live chart information but trade with fake or false money, so you can get a good feel and a good experience of how trading works before you actually risk any of your own money in the market. And then, at the same time, you can open a live account with your own money for as little as $100. Now, compared with stock trading, that would typically cost anywhere between $5,000 and $30,000 in which to open an account. And that's a minimum. That's just getting started. So you can see that Forex is very much a low-cost entry point way of trading. Now, why is Forex so popular and so rewarding? Well, the key thing is something called leverage. This is something that brokers offer their clients, and it enables you to get anywhere between 40 to 1 and 400 to 1 leverage on your money. Now, I'm just going to use an example of 100 to 1 leverage because it keeps it simple for me, for my simple brain, and also for you guys trying to understand. If I take $1,000 of my money at 100 to 1 leverage, that means I'm trading $100,000 on the market. So the other thing you need to know about is something called a pip, which is a fourth decimal place. Now, a pip stands for percentage in point. It's just a terminology that's used in Forex, but typically it's the fourth decimal place for most major currencies, and it's the second decimal place for any yen currency pairs. Now, if we base leverage of 100 to 1 on this example, what that actually means is that for every $10 of your money you trade, you will gain or lose, depending on whether you're right or wrong in your trade, 10 cents per pip as it moves in the market. If you trade $100 of your money, you'll gain or lose $1 per pip. And if you trade $1,000 of your money, you will gain or lose $10 per pip, and so on. So in summary, for every fourth decimal point move in the market in your favor, you profit $10 for that move if you trade $1,000. Also, the biggest thing as well is there's no restrictions in the market. You can profit from a falling market as well as a rising market. So as the market falls, you can make profit. As the market rises, which everyone's familiar with, you make profit as well. It depends on how you've traded and the strategy and the style that you're using. So to give you an example of that, we're looking at the pound US dollar on the daily chart. So each candlestick indicates a day's move in price, and we can see that price has moved up and flattened at this area of $1.57 to the pound. It then fell from there, and it fell all the way down to $1.49 to the pound before it turned and it rose all the way up again. Now, in terms of leverage, if I took $1,000 of my money and I sold at $1.57, so I sold the pound and I bought the dollar, as it fell all the way down to $1.49, and then I closed my trade by buying back the pound and then selling the US dollar to close the trade, I would have made 800 points or pips. That difference at $10 a pip is $8,000. So for $1,000 I would have traded and made $8,000 profit from there to there, all in the period of 1 month. So not a bad income. At the same time, looking at the market, had I then decided yes, it's turning, and bought and allowed the price to move all the way up as it rose in this trend to the very top at $1.62 and then sold out, that's 1,300 pips. And at the same time, had I placed $1,000 of my money on that trade, I'd have made $10 per pip profit, which is $13,000. So in just a short period from June to October of 2013, using $1,000 only of my money trading the pound US dollar, I could have generated $21,000 worth of profit trading only that currency pair. The thing to note is there's many more currency pairs out there to trade and therefore increase your profitability. So that's the power of trading Forex. So the exciting thing is when the Bank of Japan, and it happens with other countries as well, chooses to devalue its currency. Why does it devalue its currency? Because it's a manufacturer and it creates gross domestic product or profit and income through selling the products that the country manufactures. So when it has a strong currency, less people from other countries will buy Japanese products. So it's important for the yen to be of a low value rather than a high value. So when it decides to step in, it does announce this to the world. It tells everyone that the Bank of Japan is going to devalue the yen. And when it happens, as it happens sometimes, if we see here back in November of 2011, the yen was devalued, and in one day this big blue candlestick on the far left hand side was a 400 pip move in one day of that one currency, which is a huge move. But not only that, it's created a new characteristic in the marketplace, that when price comes all the way back down to this area where price moved up from, guess what? It pushes up again from that area. Buyers come in, and what happens is the market then takes over from the Bank of Japan and pushes the currency higher, or devalues the yen even more in reality. So we see a 400 pip move followed by an 800 pip move. Phenomenal levels of return for a low investment. If we then look at what the Swiss National Bank does to devalue the Swiss franc, we can see earlier in 2011, in here in the middle of August, Swiss Bank came in and started to push the Swiss Bank devalue the Swiss currency, the Swiss franc. Why was that? Because they want investors into their market. They want people to spend more dollars or deposit more dollars with them, and it's important that their currency is not as high as it is. So they pushed it up. They then waited for price to come back, and then they did another big push. 2 moves of 800 points in the spate of only 1 month. A massive move in the marketplace. Great opportunities to take profit. So in summary, despite the hype that's out there, Forex is a fantastic and phenomenal market to trade. Why? Because it's open 24 hours a day. It gives you the flexibility to be able to look at the markets and trade the markets alongside a job and other sources of income. It's low cost entry. You can test it, you can play around with it without it costing you too much. And it's a high reward because of the leverage. You can actually generate a good income from it once you know what you're doing. And there's a massive volume of currency and money out there that's traded. $4 trillion traded every day. So if you want to find out more about Forex, Fountain FX will help you in a step-by-step approach. It will also do it in a 24-hour day access to materials, and it also follows the low-cost principle of learning how to trade Forex without costing you a huge amount of money and without causing high risk. So thank you very much from Fountain FX.